All right, welcome. Today we're opening up the Professional Analyst Playbook. We're going to break down step by step how to build a real institutional grade investment thesis. And we're using one of the biggest companies on the planet as our live case study, Amazon.
Look, in the professional world, we don't save the conclusion for the end. We start with it. So let's get right to it. The verdict is in. Based on all the data we're about to walk through, Amazon is a compelling buy opportunity right now. Simple as that. The analysis is clear, and the signals are all lining up.
But just saying buy is the easy part. The real value, the real skill isn't in the what, it's in the why, and maybe even more importantly, the when. So how do you move past just having an opinion and actually build a data-driven case for the perfect time to invest? That's the big question we're going to answer today.
To do that, we use a framework. It's built on 5 key pillars. We'll kick things off with fundamental strength. Then we'll look at valuation to see if the price is right. After that, we check market momentum, learn how to decode the fine print, and then finally, we'll pull it all together into an actionable entry strategy. Let's get into it.
Okay, pillar number 1, fundamental strength. This is the absolute engine of any good investment. Before we look at anything else, we need to find undeniable proof that the business itself is firing on all cylinders.
And for Amazon, that proof boils down to one absolutely staggering number: 144%. That's the projected increase in their earnings per share over the last 12 months. We're not just talking about growth here. This is an explosion in profitability, and it's the solid bedrock of this entire buy thesis.
And you can see this isn't some one-time fluke. Just look at the trajectory. It's a clear, accelerating path from $2.90 to $4.67, and now it's on track to blow past $7. This is what you want to see: consistent, quarter after quarter acceleration. It's telling us the company's profit machine is really starting to hum.
Now, to really put that growth into perspective, let's stack it up against the S&P 500 and its own sector. I mean, the chart says it all, right? Amazon isn't just beating the market, it's absolutely lapping it. Its earnings are growing nearly 5 times faster than the S&P. This is the kind of raw power that defines a true market leader. So, we established Amazon is a fantastic company. But hey, that's only half the battle. A great company is only a great investment if you buy it at the right price. So let's move on to pillar 2 and see why the valuation is so attractive right now. And this is where the story gets really compelling. You'd think with the stock price climbing, it's just getting more and more expensive, right? Well, get this. The company's price-to-earnings ratio, a key way we measure valuation, has actually fallen by 37%. The stock has gotten fundamentally cheaper even as its price has gone up. So how in the world is that possible? The answer is right here in this quote. It's the whole key. The E in the PE ratio, the earnings, has been growing so incredibly fast that it's actually outrun the stock price itself. It's like a runner getting so fast that their lead just keeps getting bigger. This is what we call PE compression, and it creates a fantastic entry point for new money.
Now let's be real. Amazon still trades at a premium. It's about 47% more expensive than the average S&P 500 company. But as we just saw with its incredible growth rate, it more than earns that premium. You pay up for quality, and in this case, the price for that quality has actually come down quite a bit. Okay, strong fundamentals? Check. Attractive valuation? Check. Now for pillar 3, market momentum. This is where we shift our focus from the company's business to the stock itself. How is the market actually behaving? What are the charts telling us?
And what we're seeing here is beautiful. It's a clean sweep. Short-term, medium-term, and long-term momentum are all in the green. This tells us that everyone, from the fast money traders to the long-term investors, is on the same page. The buying pressure is consistent across the board. So the key takeaway here isn't just that the numbers are positive. It's that they are all aligned. This convergence is a really powerful technical signal. It tells an analyst that this bullish trend isn't just some flash in the pan. It's actually getting stronger, which seriously reduces the risk of buying in at the wrong time.
Now this next section, this is what really separates the amateurs from the pros. It's about decoding the fine print. It's about learning how to look at data that on the surface might even seem negative and knowing what it really means. This is a crucial skill.
First off, let's just lay down the institutional foundation. Amazon has a Zacks rank #2, which is a buy. You've got 11 analysts raising their earnings estimates, a top-notch A for its growth score, and just a massive amount of shares traded every day. Clearly, the big money is bullish.
But then you see this, and it looks scary. billions with a B of dollars in stock sales from the top executives, including Jeff Bezos himself. A novice investor might see that and hit the panic button, thinking, oh no, the insiders know something bad is about to happen. But a pro knows to dig one level deeper.
And here's the real story. The selling isn't a red flag. It's not a signal of fear, it's programmatic. It was pre-scheduled, sometimes months in advance, through what are called 10b5-1 plans. It's basically how executives cash out their compensation and handle their taxes. Understanding that context is absolutely key to not misreading the headlines.
All right, we've done the research, we've built the case. Now for the most important part, turning all this analysis into a concrete, actionable plan. Let's talk about building your entry strategy.
Given how strong all the data looks, the strategy is to start a position now. But to manage risk, you never go all in at once. A professional approach is to dollar cost average. That means you plan to enter in maybe 3 or 4 chunks over the next 6 to 8 weeks, using any little pullbacks or dips as your chance to buy.
And those buying opportunities aren't just random guesses. They're tied to specific, data-driven triggers. We're watching for a pullback to a key technical support level. We're thinking about adding to the position before a big catalyst like an earnings report. Or maybe we just take advantage when the whole market gets weak for a day or two. It's about being disciplined, not emotional. So, what's the potential payoff? Well, in our base case, which is right in line with what most analysts are thinking, we're targeting a 20 to 29% upside over the next year, year and a half. But if things go really well, say AWS reaccelerates, a bull case with up to 50% upside is absolutely on the table. So let's just wrap it all up. The thesis is crystal clear. We have a solid buy rating that's supported by 5 data-backed pillars. Explosive earnings growth, a valuation that's getting cheaper, momentum that's all pointing up, strong backing from the big institutions, and tons of liquidity. Each pillar just reinforces the others, creating a powerful professional case. Look, we use this framework today to build a really compelling case for Amazon. But the framework itself, that's the real prize here. It's a repeatable process, a playbook you can use to identify your own high-conviction opportunities. So the final question I'll leave you with is this: what opportunity is this framework going to help you find next?